Today, we're diving deep into the best dividend ETFs you need to know. Dividends are powerful, like getting paid to own stocks. If you've ever wondered how to build wealth passively, dividend ETFs are a game changer. We'll break down 5 of the best options. ETFs are baskets of stocks or assets that trade on the stock exchange, just like a single stock. Dividend ETFs focus on companies with consistent dividends. You get exposure to multiple companies, reducing risk while earning payouts that can compound over time. It's a proven strategy. Being patient and consistent with dividend investing can lead to steadily growing wealth. The first ETF is a favorite among dividend-focused investors, a fund targeting high-quality, dividend-paying U.S. companies. Think of it as the foundation of your portfolio. These funds typically include giants in technology, consumer staples, utilities, and healthcare. Examples include Johnson & Johnson, Procter & Gamble, and Microsoft. The advantage is stability. These aren't speculative stocks. They're established businesses with long histories of paying dividends. Next up, we have ETFs focusing on high-yield dividends for those looking to maximize income. These include companies with above-average dividend payouts. Sectors like real estate, energy, or telecommunications typically feature these companies. The appeal is clear: more dividends, more cash flow. However, higher yields often come with higher risk, so it's essential to balance these with more conservative dividend funds. Many savvy investors mix high-yield ETFs with core dividend funds to capture income without excessive risk, especially if reinvesting dividends. International dividend ETFs invest in companies across Europe, Asia, and other emerging markets. They provide global exposure and diversification. These ETFs give you access to global giants and industries not available in a US-only portfolio. It's a great way to diversify. Keep in mind, currency fluctuations and geopolitical risks can affect returns, but they help balance your risk and offer growth opportunities. Another category to consider is dividend growth ETFs. They target companies that consistently raise dividends over time. Dividends are important. Companies like Apple, PepsiCo, and Visa often appear in these ETFs, reflecting strong financial performance. Dividend growth offers a dual advantage of income and portfolio appreciation, significantly outperforming simple, high-yield strategies over time. These funds focus on industries known for steady dividend payouts, such as utilities, consumer staples, or healthcare. By targeting these sectors, investors can fine-tune their income strategy based on their risk tolerance and market outlook. Utilities, for instance, provide consistent dividends even in downturns because people need electricity and water. It's vital to avoid over-concentration. Sector-specific ETFs work best as complements to broader dividend ETFs. If you invest $10,000 in a core dividend ETF yielding 3% annually, that's $300 in dividends each year. Now imagine adding a high-yield ETF with a 5% payout. Your income jumps to $500 annually from that part alone. Over a decade or two, these strategies can transform a modest investment into a substantial income-generating machine. Don't put all your eggs in one basket. A balanced dividend ETF portfolio might include a core U.S. dividend fund, a high-yield fund, and more. By combining these, you spread risk across companies, sectors, and regions. If one area underperforms, the others can compensate. Remember, dividend investing is about consistency over time, not chasing short-term gains. Patience and discipline are your best allies. Pay attention to fees. ETF expense ratios vary, and even a small difference can add up over time. Look for ETFs under 0.5%. Tax efficiency is also a factor. Be aware of tax implications helps you plan smarter. Small differences can compound over the years. Dividend reinvestment plans, or DRIPs, allow you to automatically reinvest dividends into more shares of the ETF, creating a snowball effect. This accelerates wealth growth as your dividends earn more dividends. Many brokers offer DRIPs with no additional fees. The key here is consistency. The earlier and more consistently you reinvest, the greater the compounding impact. Investors worry about dividend cuts due to economic downturns or company struggles, making diversified ETFs essential. While a single company might cut dividends, diversified ETFs cushion the impact across many holdings, helping you stay calm. Dividend ETFs aren't just for retirees. They can supplement portfolios, provide cash flow, and reduce volatility. Younger investors can use dividend ETFs as growth components while building passive income streams early. Dividend investing is less about timing the market and more about staying invested over the long term. Regular contributions, whether markets are up or down, create a compounding effect that smooths out market cycles. Consistency beats trying to predict market tops and bottoms. Economic cycles affect dividend-paying companies. Utilities and consumer staples tend to be more resilient in downturns. By holding diversified dividend ETFs, investors balance exposure across sectors that react differently. Dividend investors often develop patience and discipline. Receiving regular payouts reinforces the value of long-term investing. Watching dividends grow over time provides both psychological and financial rewards. Technology and online tools make dividend investing easier than ever. You can track ETF performance, set up automatic contributions, and monitor dividend schedules. Many investors use alerts to stay informed about dividend changes, payouts, and market news. Technology streamlines portfolio management. Imagine combining a broad U.S. dividend ETF, a high-yield ETF, an international dividend ETF, and a dividend growth ETF. Your portfolio spreads across hundreds of companies. Each quarter, you receive dividends that are reinvested automatically, compounding steadily over time for income and portfolio growth. Investors should remember that past performance is not a guarantee of future results. Market conditions change, but core principles remain sound. Combining strategies with ongoing learning and portfolio review positions investors to maximize returns over time. It's important to periodically rebalance your dividend ETF portfolio to maintain your intended allocation and risk profile. If high-yield ETFs outperform and take up a larger portion, trimming shares and reallocating to core or international ETFs helps maintain balance. Many investors combine dividend ETFs with other income strategies, like bonds or real estate, to diversify. Bonds provide fixed income, while dividend ETFs add equity exposure, reducing overall portfolio volatility. Sustainable and ESG dividend ETFs focus on companies with strong governance practices while providing income, aligning ethics with finances. Behavioral discipline remains critical. The temptation to chase higher yields can erode long-term results. Dividend ETFs can serve as a hedge against inflation. They offer pricing power and the ability to grow earnings. This growth leads to higher dividends, helping maintain real purchasing power in your portfolio. Watching dividends accumulate reinforces disciplined investing habits. Regular payouts keep investors engaged. Dividend ETFs can be passed on to heirs, providing ongoing income while maintaining equity exposure. One of the often overlooked benefits of dividend ETFs is their versatility across different market conditions. Unlike growth-focused ETFs, dividend ETFs provide a steady stream of income regardless of market volatility. This consistency is valuable during recessions. Investors who rely solely on capital appreciation often feel pressured to sell. With dividend ETFs, the dividends continue to flow, offering a source of reassurance and stability. Another key factor is sector diversification within dividend ETFs, reducing exposure to sector-specific risks. Tax efficiency is another crucial advantage. Qualified dividends are taxed at a lower rate than ordinary income, making dividend ETFs more attractive. Some dividend ETFs are structured to minimize capital gains distributions, further enhancing tax efficiency. This can mean keeping more money working for you. The compounding effect of reinvested dividends coupled with tax efficiency can significantly amplify overall returns over decades. Automatic dividend reinvestment plans, DRIPs, allow investors to purchase additional shares with earned dividends, compounding wealth over time. Small, consistent reinvestments can grow into substantial holdings. An investor could potentially double or triple their portfolio in 15 to 20 years. The long-term effect of compounding, especially with growing dividends, is a powerful wealth-building mechanism for everyday investors. Dividend ETFs can act as a buffer against inflation. Companies that consistently increase dividends often have strong pricing power, passing cost increases to consumers. This pricing power allows dividends to grow over time, maintaining real purchasing power. For example, if a dividend ETF yields 4% today and dividends grow by 5%, the real yield protects income. This makes dividend ETFs especially attractive in inflationary environments, where traditional fixed income products like bonds may fail to keep pace with rising costs. Another significant factor is global reach. Some ETFs focus on U.S. companies, while others provide exposure to international dividend payers. This global exposure allows investors to capture opportunities in emerging markets, Europe, and Asia, offering higher yields due to differing corporate practices. The presence of dividends provides a tangible reward even when stock prices are temporarily falling. Receiving regular dividend payments helps investors psychologically separate income from market price fluctuations. This emotional benefit is particularly valuable for younger investors who may face market volatility over multiple cycles. Dividend ETFs encourage patience and discipline, traits that are statistically correlated with superior long-term investment performance. For income-focused investors, dividend ETFs offer a reliable alternative to bonds, especially in a low-interest rate environment. Dividend ETFs provide exposure to equity income, often outperforming bond yields over long periods, while offering potential for capital appreciation. The combination of income and growth makes dividend ETFs a hybrid solution, blending the stability of fixed income with the upside of equities. Long-term investors should consider the compounding effect of dividend growth. Companies that consistently raise dividends exhibit strong fundamentals. Dividend growth ETFs aggregate these companies, creating a self-reinforcing ecosystem. As dividends grow, reinvested dividends buy more shares, generating even more dividends. Modest dividend growth rates of 5 to 6% per year can substantially increase portfolio value and generate a reliable income stream in retirement. Dividend ETFs reduce the temptation to chase speculative growth stocks and typically include mature, cash-rich companies. In periods of market uncertainty, these ETFs often experience less volatility, offering both income and relative stability. Pension funds and endowments allocate to dividend-focused strategies, combining yield with relative safety. This recognition adds credibility to dividend ETFs, making them a core component of a well-structured, long-term portfolio. Dividend ETFs benefit from economies of scale and efficient management, reducing costs for investors through lower expense ratios. Unlike mutual funds, ETFs offer liquidity and transparency, allowing investors to buy and sell shares throughout the trading day. This combination makes dividend ETFs accessible for investors at all levels, from beginners to seasoned professionals. Dividend income provides predictable cash flow for retirees who want to avoid tapping into their principal. Reinvesting dividends can compound wealth, creating a larger retirement nest egg over decades. Look for ETFs that emphasize quality, companies with low payout ratios, consistent earnings, and strong balance sheets. These factors increase the likelihood that dividends will continue growing even during economic downturns. Technological advancements and automation have enhanced dividend ETF performance, optimizing selection and monitoring. Robo-advisors, algorithmic trading, and AI-driven analysis allow investors to efficiently reinvest dividends. These tools democratize access to portfolio management, giving retail investors a competitive edge. Dividend ETFs now align with socially responsible and ESG-focused strategies, meeting investor values. Dividend ETFs provide stability, growth, and compounding power for long-term wealth and reliable income. If you found this breakdown helpful, hit the like button, subscribe for more insights, and share your thoughts.